Hey everyone, my name is Jack, and welcome to This Explainer. Today we're totally demystifying a huge milestone, earning 1 lakh rupees per month. We are moving right past all the internet hype and looking at the actual math, the real effort, and the concrete strategies you need to build serious wealth.
Okay, let's dive right into this universally desired income goal. We're stripping away the noise to see what it actually takes to hit that 1 lakh mark. I mean, how do you actually get there? Do you just grind it out? Do you start a business? Or do you just let your money work for you? Let's figure it out. Here is our blueprint for today. We're going to cover zero capital active hustles, the e-commerce route, the harsh reality of passive income, beating the inflation trap, and finally, choosing your ultimate wealth path. All right, section 1, zero capital active hustles. This is all about leveraging your time when your capital is sitting at absolute zero.
So, if you're sitting there thinking, Jack, I have literally zero money to start with, don't worry. Your time and your skills are your most valuable currency right now. There are 4 proven routes you can take here. You can leverage banking referral programs, build no-code automations for local businesses, get paid to test video games on platforms like Playtest Cloud, or even manage Discord communities for brands. Every single one of these requires zero financial investment to get off the ground. To show you how accessible this is, look at the IDFC First Bank program. You literally just download an app, verify your identity with your PAN and Aadhaar, get a digital ID, and start referring banking products. It's a completely paperless process. You're essentially acting as a financial connector, earning commissions just by bridging the gap between a reputable bank and people who need accounts or loans. Pretty brilliant, right?
But maybe you're a bit more tech savvy. In that case, no-code automation is an absolute game changer. By mastering simple tools like Odoo or Zapier, you can easily charge retainers of 10 to 15,000 rupees just by saving small businesses from tedious daily work. Imagine a local coaching center spending hours manually tracking appointments. You set up a simple automated workflow, save them hours of headaches, and they will gladly pay you a monthly retainer for keeping things running smoothly. Moving right along to section 2, the e-commerce route. This is our moderate time and capital approach. If you want to scale faster than a purely time-based hustle and you have a little bit of capital, dropshipping is incredibly interesting. According to CIM, average dropshipping profit margins in India range from 20 to 50%, and you completely bypass the nightmare of physical warehousing. You don't buy inventory up front. When a customer orders, your supplier ships it. Your main job is marketing, and if you manage your ad spend well, you're looking at a very healthy 35% average profit margin. But listen, the secret sauce here is picking high-utility niches. Things like premium pet supplies, organic skincare, or smart home gadgets. You can't just sell generic phone cases and expect to hit that 30,000 to 2 lakh monthly bracket. You have to target specific, passionate audiences with products that actually solve a problem or have real emotional appeal. Okay, section 3. The passive income reality. Let's look at the math behind doing absolutely nothing. Look, we all dream of just kicking back and getting paid, right? But here is a massive reality check. Data shows that to safely earn 1 lakh a month post-tax purely from a standard 7.2% fixed deposit, you need a ready-to-go corpus of 2.4 crore rupees. Let that sink in for a second. To earn 12 lakh rupees a year completely passively, you need over 2.4 crore sitting in the bank. Which brings us to section 4, beating the inflation trap and the hidden risks of just sitting on cash. Picture this. You finally do the responsible thing. You start saving money. Every month, you move a little bit into your savings account. You feel good about it, responsible, disciplined, financially mature. But then one day, you realize something strange. Your money is just sitting there, barely earning any interest. Because saving money is good, but saving alone rarely builds real wealth. If we assume a 6% inflation rate, the 12 lakhs a year you need to survive today will skyrocket to over 2 crore a year by the time you're 90. Savings protect your money, but investments grow your money. And those are 2 very different jobs. This is where a lot of people get stuck. They know saving is important, but they have no idea how to transition from saving to investing. And the reason isn't math, it's psychology. Saving feels safe. Investing feels risky. When your money sits in a savings account, it doesn't fluctuate. It doesn't drop on a random Tuesday. But investments, they move. Sometimes up, sometimes down. And that emotional volatility scares people away. You're effectively caught between the reinvestment risks of safe debt, where interest rates might drop, and the sequence of returns risk in the stock market. Just look at this historical simulation. It proves that relying solely on equities forces your withdrawal rate to climb dangerously high as you age, just to keep up with inflation. If a bear market hits, like that massive 52% drop back in 2008, and you're forced to withdraw money just to live, you are permanently and rapidly depleting your base capital. And hey, if you think you can just outsmart this by using a relatively safe 3% dividend-yielding stock to generate that income, you would have to concentrate an incredibly risky 4 crore rupees into a single asset. Putting that much wealth into one single company is practically begging for disaster.
So, Section 5. Choosing your wealth path and building the ultimate portfolio. How do we fix this?
We need a step-by-step path to turn saving into investing without panicking. Step 1, build a real emergency fund in pure cash. This protects your investments from your own life. Step 2, separate saving from investing mentally. Think of it as 2 buckets. Your safety money doesn't move, but your growth money, like your equity funds, is allowed to fluctuate. Step 3, start small and focus on simple investments first. As you can see here, the most realistic blueprint involves a simple, consistent mix. Tax-efficient debt mutual funds for stability, a moderate chunk in equity funds to beat inflation, and utilizing systematic withdrawal plans. Consistent investing in a simple portfolio almost always outperforms complicated, risky trading. Since there are absolutely no shortcuts to wealth, the only question left is this. The gap between where you are now and that one lock a month goal is bridged entirely by action. So what path are you going to take today to start building your foundation? Will you leverage your time, or will you leverage your capital?